Hello, thank you for being here. So today we're going to talk about how you can invest in great companies, meaning what are the indicators that tell you that is probably something you should allocate your capital to. I'm talking private markets, obviously. But also I want to talk about how we can build a better capital market. The two are very linked. I'm Peggy van der Plas. Thank you for being on the podcast, and you can check out my website at peggyvanderplas.com. So I was at an event a couple of weeks ago, and it was an anniversary, 10th anniversary of a company, which, if you know, means a lot because not many companies survive, and especially not 10 years. And the name of this company is FrontFundr, and I have known them for a while, and they're based here in Toronto, in Canada. And it was very fun. It was a bit like alumni reunion. Not that I go to my business school alumni reunion, but it looked like that. A lot of people from the ecosystem, founders of company, investors. It was just fun. And what FrontFundr does, actually, it's an equity crowdfunding platform. They do debt, actually, but mostly equity. So what does it mean is that companies, usually mostly startups, go on their platform, show their financials, explain why you as an individual investor should allocate capital to them. They explain their growth plan and the whole shebang. So it's really a fundraising platform for startup. And in 10 years, the organization has processed close to 300 million investments. So if you think for a second, if a VC fund in Canada had, not just raised, but also allocated 300 million to companies in 10 years, that would be a great success. I know funds elsewhere in the world might be bigger. In Canada, 300 million, that's a big number. And they actually processed this amount from close to 20,000 investors. So I had invested through the platform in the past. I actually invested in FrontFundr. I used to be an investor. I used to be a board member as well. But this number is very, very impressive, and it should really, I would say, stop you in your track, especially if you're in Canada and you know the Canadian environment, that fundraising is very challenging here. And so I was introduced to the founder, Peter Paul van Auken, 8-9 years ago. So he was really at the inception of his company, and I've always been very bullish with crowd equity fundraising. I had already invested in another platform in the US called WeFounder, and also invested through the platform. So I became an investor in FrontFundr. That was making sense for me to have the same company, one in the US, or similar business model, should I say, one in the US, one in Canada. And what I really, really love from the start, from this platform, from this business model, is it was not just about democratizing the access. So meaning for investor like you and I, in the past, you had to be a qualified investor, and you had to make way more significant check. Here you can make very small check, which is great. But it was also, on the other side, it was also the opportunity for companies to rethink how they access capital, which is not always easy. And I really think that crowdfunding is a strategic capital tool. So I don't think it's right for every company or every moment, but when you use it very thoughtfully, it can be extremely valuable. So first, if you're a B2C startup, meaning you're selling consumer product directly to people, your crowdfunding campaign, so where you go out to your community, social media, explaining what you're doing and why people should invest in you, it doubles down as a marketing campaign, because at the same time you're talking about, well, your product, your company, why it's great. So there is, I think, a great value when you're doing a good, crowdfunding campaign, which is important. If you don't communicate well, that's not going to be very successful, similar to a marketing campaign. But you get a lot of return if you're a B2C, because you're reaching both goals with one campaign, which I think is great. What I also like with private equity fundraising is that it is more forgiving that institutional capital, institutional investors, like you don't necessarily need to have this hyper growth that venture capital have. You don't end up, being strong armed of your company with, VCs coming on your board and maybe deciding that you're not the right fit anymore, which is a real concern. That's happening quite often. So I really, really enjoy crowd equity fundraising for many type of startups, especially I would say consumer goods, that I think it's a great match. And they've had massive success with exactly this B2C. I'm not sure it's amazing for a B2B SaaS company, to be honest, but they've also seen success in that. But B2C is great because you also benefit of the marketing aspect. So maybe you've listened to another conversation I had last month, I believe, with Bryce Sishuk. So Bryce is a former entrepreneur. Now is an investor through his family office with a couple of his former colleague, and he has invested in many companies across the past 10 years actually. And I would say his message to founders now, it's really about to be mindful of raising VC money. And again, we have the same school of thought, is that VC money has a time and place, but what we made in the last 10 years, when it was really a big boom, interest rate at zero, when I say 10 years, I should say 15 years, everyone should raise tons of money through VCs, regardless of their stage, regardless of their business model, but I don't think it's true. That has killed a lot of company. And again, VC has a time and place. It is not a case against VC, but founders should understand the trade-off. I don't think they always understand the trade-off. Like the pressure for speed, the power dynamics as well, the dilution risk that can be also pretty intense. So crowdfunding really offers an alternative route. It's aligned, it's founder first, it's community driven, so very different mindset. So and this alignment of the capital you're raising with your company is also something I see in another capital model I believe in, and she's going to be on my podcast next month. Melissa Widner, she's the CEO of Lighter Capital, and that's really this non-dilutive revenue-based financing, which is basically meaning debt capital. And Lighter Capital focuses on tech companies who can show recurring revenue because, well, they need to repay their loans. But that is a great strategic tool that can use as well alongside equity crowdfunding. So yes, you need to obviously reimburse these funds. Yes, there is an interest, but you're not diluting yourself. You're keeping your equity. And I mean, if you can manage with only loans, it's good as well because, well, if you believe in your company, you want to retain as much equity as possible. The combination of both, I think, like this revenue-based financing and this crowd equity financing, I think is a great opportunity for a lot of early stage companies they provide loans in Australia, in Canada, in the US. So I think it's a good model in many countries. So and the beauty really of companies like Lighter Capital or FrontFundr is that they're young companies, they're agile platforms, they have had to raise capital themselves. So they really understand their clients because they are their clients, like it's very different than, dealing with a VC, dealing with a bank, like you're really talking with peers here. So they're really not just service providers, they're co-builders as well. So During the event, so that birthday, that anniversary event of FrontFundr, Peter Paul had organized a couple of panels, which I think was very nice. So we had networking and we had panels. And one of the panel was actually more like a fireside chat with a gentleman that's quite well known here in Canada. His name is Joe Canavan, and he was named Angel Investor of the Year here in 2025. And Joe really has that rare combo of investor rigor, but also entrepreneurial empathy. He's done it, he's been there, he understands what it means to be an entrepreneur, and he shared his approach to identifying what in his mind makes a company investable today. So what are his best practices when he allocates capital in determining, okay, should I or shouldn't I write a check? So one of the first things he likes to look at is what is the board of advisors? So are they experienced? Are they strategic? Are they founder supportive, especially if the founder or founders are on the younger side? You want to make sure that there is a wealth of wisdom that is available to support the founder. The second thing is the cap table quality. So that touch a bit on the board of advisors, because usually advisors are also investors. So we really want to see what we call smart money with, value adding investors. He was mentioning something interesting. He doesn't really like to see big pension plan, this type of things, because he say early stage, they bring too much money. They don't necessarily understand how early stage companies work, and they don't necessarily bring a lot of value to the company. So he really looks at on the cap table what is the quality of the investors. Obviously, he's looking at the market size, that's obvious, but the most important thing he looks at is the founder or founders' character. It's always the top filter for him. He meets the family of the founders. He looks at alignment in the values because he knows that it's a long journey. And you, as an investor, you're going to spend a lot of time. If obviously you're also an advisor and you're getting close to the company, you're going to spend a lot of time working with them, helping them. And you need to like the people you're going to be stuck with, because it's also going to be a very long journey, long and painful. So you want to make sure that you like each other and you align on the value side. And so the value of this filter of character, it's really to understand that whether the founder will do the right thing when things get hard. So it's not just the business plan. As you know, early stage companies, they pivot 25 times. So it's really about, will the founder make the right move when he has to and when the going gets tough. So I personally resonate with what Joe's saying. I have a few more filter I'm gonna share with you. So what I look when I see a pitch deck crossing my desk is if the funding team is very tech heavy, so people who are really tech focused, they tend to struggle to commercialize. So I really like to have a balance between a business acumen and technical depth. Ideally, co-founders, one that's tech focused, one that's a business focused, so you can have a nice balance, because very often tech focused founders, they focus more on their strength, which is the technology, the product. Similarly, I looked at cultural background, because it does influence the go-to-market strategy. So if you look at companies that are built by Americans, by Israeli, they tend to lead with sales. They're very strong in sales and marketing, commercialization. If you look at companies that have founders from France, from Canada, that's going to be a bit different, because they lead with product. And so that matters depending on what you're looking for. I personally realize that you want to lead with commercialization. Yes, the product need to be good. You don't want a Theranos situation here, But you really need to have a strong commercialization plan and expertise, because the best product in the world, if it's not sold properly, it doesn't matter. It's not going to go anywhere. I also look if a company has raised a lot of institutional investors, because I assume there's going to be waste, and like it's like everyone. If you're giving someone a lot of money, well, they might not always use it mindfully, and that's something I've seen with a lot of organization, is if you give them a lot of money too early and they have to burn it in the next 18-24 months, well, they might not always allocate it very mindfully. So that's something I'm also looking at. So again, for early stage investments, whether it's through crowdfunding platform, whether it's as an angel and you're getting pitch decks, I do focus on founder mindset, obviously, the capital efficiency, the ability to evolve. And, I look at it as pattern recognition is great. That has really helped me, but you really also need to have a good people recognition. Like you need to understand who the person is going to be, which brings me to my next point, which I think more investors considered or would be aware of, is the fact that early investors often get diluted later by institutional capital. So let's say I put one of the first check as an angel for a platform for directly with a founder, and then 3 years later a VC comes, the VC puts string attached with its check, which is diluting more than reasonable the early stage investor. That's when you need to have a founder and a CEO with strong values that's going to say, I'm not over diluting my early investors, because they're the ones who were there to help me get off the ground. And I can tell you that has happened more than once to me, where I invested, was one of the first check, and the company doesn't exit, and I look at how much I was diluted, and it was, like sometimes like 1 to 10 compared to later stage investors. And you're like, well, I took most of the risk. Without me, you would not be there. So you really need to have, again, funders who, put their foot down and protect their early stage investor, which means character, which means values, and sometimes saying no to what might look like a potential great deal. But, like if a VC is asking you to do something that is, I'm sorry, unethical, because that is what it is, they're probably not the right partner, because they will not hesitate to do the same thing to you. Seems logical. So, so my final thoughts here is really this idea that we can look, thanks to platform like FrontFundr or WeFundr, capital really can be inclusive, it can be strategic, it can be aligned with founder success, which is why I really like this idea of private equity platform. I think it's better to, especially for B2C solution, to see the appetite on the market, in the market, by people who are willing to put a check behind you and buy your products and become an ambassador of your products. That may be institutional investor, where you're just going to be one of the many companies in their portfolio. So I really think this is a great system for organization. I'm not saying it's easy, let's be honest. A great system for startups to raise capital and, again, raise awareness as well. So if you look at platforms, again, like FrontFundr, Lighter Capital, they're really building something better, I think, and something that is needed in the ecosystem, very early stage. It's more human. It doesn't just generate returns. It also builds company that we actually want in the world, like the money and the mouth are aligned. So that's what I had to say. And a big congrats to Peter Paul, FrontFundr, and the team. 10 years, it's a big thing. And again, if you are a founder, you should definitely look at the option with prod equity fundraising, whether you're in the US, whether you're in Canada, because that is definitely a great option. So once again, my name is Peggy van der Plas. Thank you for watching, listening. Don't hesitate to subscribe so you'll see the future podcast with Melissa, which should be in 2-3 weeks. And I wish you a wonderful day and week. Bye bye.